The European Central Bank holds its official interest rates and markets see an 80% chance it will be able to cut again in September. US stocks are edging lower with ongoing nerves about tech stock valuations, and Australian unemployment rises a bit, which has seen reassuring the RBA. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ commodity strategist Soni Kumari tracks the boom-bust cycle for lithium in recent years due to volatility in demand for electric vehicles.
With lithium trading deep into the cost curve, high-cost producers are likely to exit the market.
But first, in 5 and 5 with ANZ, the ECB held its official interest rates overnight as expected, and markets see an 80% chance of a second cut in September, up slightly from 78% before the decision. ANZ's head of G3 Economics, Brian Martin, says the ECB hasn't pre-committed to another cut, but comments about wage inflation being a legacy issue from the post-decision press conference with ECB President Christine Lagarde were supportive of more easing.
The future assessment for inflation remains encouraging, and the ECB's forecasts are that in the second half of 2025 inflation will be back at target. So based on that, and if the path of inflation in coming months unfolds broadly in line with the June forecasts produced by the ECB, I think they will be in a position to cut interest rates 25 basis points in September and by another 25 basis points in December.
The Nasdaq was down 0.9% by 4 a.m. Sydney-Melbourne time, and the S&P 500 down 0.8%. Treasury yields were up 2 to 3 basis points, and the US dollar index was up 0.4% with those high yields. The Aussie dollar, therefore, was down 0.3% at 67.08 US cents, and the Kiwi was down 0.35% at 60.51. Number 2, Australia's unemployment rate ticked up to 4.1% from 4% in June, while jobs growth beat expectations at over 50,000. ANZ senior economist Blair Chapman says despite those extra jobs, the labour market is continuing to slow, which would please the RBA.
This figure being a low 4.1 is bang on what they were estimating during the May S&P round. So they had a 4.0. Today's number gives them exactly that. So in terms of unemployment, right on their expectation. I would expect that employment's growing much faster than they were thinking, but it hasn't been particularly strong in terms of the underlying hours worked. So if you look at quarterly hours worked growth over the year, it's only been about 0.4% year on year, which is pretty weak in terms of hours worked growth.
Number 3, Blair says the middle-of-the-road jobs data means a lot is now resting on Australia's June quarter inflation figures at the end of the month for the markets to work out what direction interest rates might be headed.
The data wasn't particularly weak, which should see the RBA needing to cut immediately, and it wasn't particularly strong, so no additional reasons to hike out of this number today, and really is now sort of resting on the Q2 CPI number, which is coming up on the 31st of July.
Number 4, Japan's exports rose 5.4% in June from a year ago. That was less than expected, but provided support to June quarter GDP, which turned negative in the first quarter. Meanwhile, the yen has staged a turnaround in recent days, trading at 157.25 to the US dollar, when it had been at 161 last week. Here's ANZ FX analyst Felix Ryan.
We do have early signs that suggest what occurred in terms of those sharp moves just following US CPI last week probably was, on the balance of probabilities, probably was more likely intervention than not. So we do have some FX liquidity indices on our end that has data on spreads and volumes, and the real sharp rise we saw in volumes around Thursday, Friday last week, and also the sharp deterioration in liquidity is on par, I suppose, with the previous episodes of intervention.
Number 5. Malaysia's June quarter GDP data out today is expected to show 4.5% growth from a year ago. That's up from 4.2% growth in the first quarter. ANZ economist Arindam Chakraborty is looking for 3 key drivers for growth.
Firstly, consumption goods imports recorded double-digit growth in the second quarter of 2024, while retail sales and consumption credit grew at a solid pace. These indicate resilient household spending over the quarter. Next, the strong increase in capital goods imports along with rising production of construction-related goods points towards solid growth in overall investment. And finally, with electrical and electronic products exports picking up pace in the second quarter, we expect a smaller drag from net exports over the quarter.
Arundam Chakraborty there. Now, in our bonus deep dive interview, ANZ commodity strategist Soni Kumari talked to my colleague Alex Tarrant about the boom-bust cycle for lithium in recent years, all because of volatility in demand for electric vehicle batteries, starting in 2021 when EV sales doubled.
So seeing this demand rise, EV manufacturers have started restocking lithium as they feared there will not be enough lithium. And this resulted in an inflated demand which deepened the market deficit, and as a result, we saw prices skyrocketing from 11,000 to 85,000 by the end of 2022. So as a normal phenomenon, the price rise led to a strong supply response because even high-cost lithium producer could make a profit margin. So right from the upstream miners to downstream producer promptly responded with aggressive plans to either ramping up existing capacities or accelerating new projects to benefit from the price rise. And at the same time, demand growth of lithium slowed with incremental EV sales normalizing to 30% last year. And to worsen the demand situation, Western OEMs scaled back their ambitious EV plans, resulting slowing demand for lithium and lithium-ion batteries. So companies which built inventories for raw materials and batteries in expectation of rising EV sales at the same pace, they wanted to get rid of their stock, and that led to a strong destocking, which is still underway. And this resulted a lower demand than actual consumption, and price plunged through 2023, and still it's in downtrend so far in this year.
But we're still expecting sales of EVs to continue growing, just perhaps not as fast. So what is the outlook for EV demand and the flow through to lithium?
So we see the current destocking is a temporary drag for the lithium market as the structural story for rising EV penetration remains in place. So countries are set to accelerate their pace of energy transition over the coming years, which will in turn support EV sales and energy storage. So what we are likely to see in a normalization in EV sales growth in the range of 20 to 30%, and with an estimate of EV penetration rising to more than 40% by 2030, global EV sales is set to grow annually by 17 to 18% through 2030. And lithium-ion battery will largely follow the path of EVs and energy storage, which will gain momentum with increasing deployment of renewables. So we see lithium demand rising annually by the similar rate of 17 to 80% through 2030.
We've still got some of that oversupply issue showing through. So is that going to affect some producers over others?
Yes, with lithium trading deep into the cost curve, high-cost producers are likely to exit the market, while others will delay their projects or put their mines in maintenance and care mode. And some of the miners and processors are already reducing their planned expenditure over the coming years just to optimize their costs. And this is likely to happen along the lithium production chain. So as a result, green and brownfield project investments will be deferred by many companies.
So what risks are there from geopolitics? And if those risks do rise or materialize, can these batteries be sourced from elsewhere?
China holds nearly 70% of lithium refining capacity and manufactures over 80% of lithium-ion batteries. So the recent import tariffs imposed by the US and Europe raised sourcing risk around essential components for EVs and energy storage. So if there are disruption in refined lithium supply from China, then lithium and lithium-ion batteries will need to be sourced from somewhere else. So this shift in supply chain will take some time and will also come with additional costs. So just to give you some perspective here, China's production of refined lithium sits in a lower quartile of the cost curve compared to rest of the world. So to stimulate an increase in production outside China, prices need to stay high.
And is that going to happen? What is the general outlook for lithium prices now?
While market remains oversupplied, we think that the surplus is not too large as prices implied. So lithium prices are likely to stabilize soon and move towards 16,000 to 18,000 range in 2025.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, July the 19th. Catch you next week with key July PMI data from some of the world's largest economies. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.